Hello and welcome to the Investing on the Go podcast by FundCalibre. I'm Ryan Lightfoot-Brown, and today we're speaking to Hugh Sergeant, the elite rated manager of the R&M UK Recovery Fund. Hugh, thank you very much for your time today.
My pleasure.
Now, the UK stock market fell very quickly and quite a long way between February and March. On average, it was more than 30%, but some shares fell as much as 50 to 60%. You're known for buying shares at fire sale prices, so I'm assuming you were quite active during that time. So perhaps you can talk us through some names that you topped up or added to.
Yes, I mean, we are going through a period of above average, but hopefully well-considered activity. I think it goes without saying that the short-term economic background changed profoundly with the global spread of the pandemic. So actually, initially, we needed to review existing positions as well as looking for new opportunities. Some stocks did see our thesis broken by the lockdown, where there was a difficult combination of operational and financial leverage for those businesses, and we exited some of those. An obvious example being Carnival. We added to existing positions where we thought that the share price falls more than discounted the difficult short-term environment. That would have included companies such as Capital & Counties, the owner of much of Covent Garden, a business called RHI Magnesita, which is a global leading producer of consumables for the steel industry, and also Anglo American and Lloyds Bank. And then indeed we did seek new opportunities. These were typically amongst what I'd describe as higher quality business franchises, but ones that were being hit by the induced coma of lockdown, but where we thought the business franchise would survive and then prosper as we return to a more normal economic environment. Examples of that would be Autotrader, Rightmove, Next, ASOS, and WH Smith. WH Smith that's clearly more focused on the travel market and has a strong business in that area, temporarily, from our perspective, disrupted and available at attractive valuations.
Okay, that perhaps leads me on to my next question, actually. Does it mean that some of these value stocks or those value sectors are different today than they were before we went into this crisis? Previously, it was things like energy, retail, and financials. Is that still the same today, or is it things such as like the airlines or the travel stocks that are classified as value?
I think the great thing about the current universal hatred of value stocks, value, i.e. companies that are trading on low valuations, cheap versus their history, cheap versus their potential profits and cash flow. So the universal hatred of these types of stocks, or any company that doesn't fit what is now a desired profile of, say, an attractive return on capital or robust growth. Because of this universal hatred, there are many, many companies in many, many sectors that have become attractively valued. So there are the classic value sectors, some of which you named, such as banks, but also attractively valued digital economy stocks such as ASOS and Rightmove, which I've mentioned already, fund managers such as Premier Miton, specialist lenders such as International Personal Finance, house builders such as Persimmon, real estate stocks, where I've already mentioned Capital & Counties, oil services such as Hunting, and well-managed industrials available at knockdown prices such as Melrose and Vesuvius. So certainly opportunities in the value sectors you described, but actually the value opportunity is a very broad one, and particularly attractive at this moment.
Okay, and perhaps then we could talk about value traps, because you said there are quite a few sectors that do look good value, but what about those that look cheap but for a good reason? Do you really think there are any areas that won't recover from the shutdown particularly well?
Yeah, and I think that's a great point. I mean, obviously the lockdown, the shutdown has clearly reinforced some existing structural trends, clearly such as the move to all things digital. So sectors that were impacted by these trends before the lockdown are probably even deeper value traps today. Classic example would be bricks and mortar retailers. But as a value and recovery manager, I suppose that's learned the hard way over the years. We've always needed to think about the issue of value traps. Is this stock cheap for a permanent, structural, disruptive type of reason? So actually, we've consistently had more in e-commerce type stocks than bricks and mortar retailers. Having said that, I think value traps have the concept has now become I think a much overused term. So that anything that is good value today is being dismissed as a value trap, is kind of a good excuse not to invest in it. So the question you ask is no one ever going back to Covent Garden, going to the Apple Store there, to the opera, et cetera? Are people really going to give up permanently the amount of travel they do? Travel's been one of the biggest, most consistent growth industries of the last 100 years. And are they not going to visit this travel outlet as they head through airports? Personally, I don't think so. I would say we are more confident in the businesses that cater to travel and socializing. They're going to be back. It will take time, but they'll be back. So as long as the good quality businesses such as WH Smiths and Ryanair have the liquidity to survive, we are very comfortable applying capital, investing in those types of stocks.
So you've mentioned some of the bigger companies that you've owned there, Hugh, that our listeners might be used to. But what about smaller companies? You said that they've been attractive in the past. Do you still believe that?
Yeah, smaller companies around the world they've been relatively weak over the last couple of years, culminating in a very aggressive share price markdown as the lockdowns accelerated, as economic uncertainty became very significant. They were undermined by a combination of small cap having greater cyclicality, and also during a period of uncertainty, increasing premium required because of their illiquidity. So by the end of March, smaller companies, from our perspective, were clearly very attractive. They have rallied somewhat since, but this has been led by small cap growth stocks, and that's left behind a great hunting ground in small cap value. And the smaller you go, often the larger the valuation anomalies. If you go down to micro caps, there seems to be a very significant discount. A good example that we have in the portfolio been adding to is a company called Somero. They do equipment for making concrete in construction, a dominant global market position, and that concrete goes into warehouses, for example, Amazon type warehouses. So they've seen strong structural growth over the years, but the shares have been weak recently because of cyclical worries, and that's left the valuation looking extremely attractive again.
Okay, and going back to the other end of the scale, you own some of the big energy companies, the likes of BP, Shell, and things. What are your thoughts on the oil price, which has been another big story over the last couple of months? And has this impacted your thesis about owning these companies at all?
Yeah, I mean, we have actually been structurally underweight the big integrated oil companies for many years as they have really struggled to grow. So they haven't had the potential in our philosophy of potential valuation and timing. And we're not really recovery stocks. That said, there is a very clear cyclical opportunity here with the oil price being so low, unsustainably low from our perspective once demand returns, looking out to next year. And energy stocks have become particularly lowly valued. So we have added to our energy exposure. actually with a greater emphasis on the stronger oil services companies, the ones with particularly strong balance sheets.
Okay, and one of the other big stories that they've had is their dividend cuts. I mean, Shell having their first cut for multiple decades. Has this impacted the investment case for you at all? I know you're not an income investor, but it is a part of the total return.
I would say we're typically not investors who are focused on yield. In terms of our valuation approach, we use a broad range of valuation metrics, and yield would be one of the contributors, but only amongst the mix of a number of valuation metrics, so earnings multiples, price to book, price to free cash flow. Obviously, the total investors. And a lot of payments under significant short-term pressure, but we prefer to focus on business franchises where we're comfortable that they may have had to cut in the short term, but they can sustain a reasonable distribution back to shareholders over the medium term. So we'd focus more on the medium term dividend capability, the medium term free cash flow generated by those businesses, rather than shorter term dividend distribution.
Now, your style of value investing has been out of favour for a decade now. Your funds managed to outperform still. How have you managed to do this? And do you think the value will have its time in the sun again?
Yeah, I do hope so. I mean, value has been out of favour for 13 years now, actually, since the market peaked before the global financial crisis in 2007-8. It struggled, I think, for four reasons. One, value had actually done very well during the credit bubble, which led to the credit crunch. So it was due a cyclical pullback at that point. We've seen an ongoing fall in interest rates and bond yields around the world, and this has typically been far more supportive of growth and quality type stocks and has undermined traditional value type stocks. The third aspect of value underperforming has been disruption. We've already talked a little bit about that, but digital models have clearly disrupted a number of industries and created more value traps than we've seen in the past. And now, most recently, the pandemic, COVID-19, has created a big cyclical downdraft for value and actually supported growth stocks, the ones focused on the digital economy. But where does that lead us today? Where does that lead value? From my perspective, we're at the point of the best opportunity to invest in our type of stock. So that's value, cheap stocks, recovery, good quality franchises where profitability is temporarily depressed, and also multi-cap. So looking for opportunities from the largest down to the smallest. The best opportunity that I've seen in my 30-year career. But there's a potential change of narrative in terms of the economic and inflationary background, which has been consistently deflationary over the last 10 years, because policy is so aggressive to try and reflate the global economy during this difficult times. It could become over-aggressive in the context of economies recovering, which could be reflationary rather than deflationary. And that will be supportive of a value stock.
Well, Hugh, that was very interesting. Thank you very much for your time today.
Thank you. Thank you very much for your time.
And for more information on the elite rated R&M UK Recovery Fund, please visit FundCalibre.com. And for more from the Investing on the Go podcast, please don't forget to subscribe. Please note that these are unprecedented times and the market can react very quickly to news. The views expressed are at the time of recording and could change. And remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.